All right, everybody, welcome back to the Discovering Multifamily podcast. I'm your host, Anthony Scandariato, and with Red Knight Properties. And today we have a very special guest, Peter Fischer with Kirsh, who is actually a friend of mine. We met a while ago. And Peter is a partner with Kirsh as an attorney, and he's very experienced, and he works with a lot of real estate developers, operators, syndicators, even private equity providers, lenders, investors, etc. And he does some M&A and general corporate work as well. Really knowledgeable on every aspect, particularly when it comes to multifamily real estate in the syndication world. He's actually from Connecticut, but back in Venice, California, and want to welcome him here. And thanks again for coming on the show.
Thanks so much for having me. Pleasure to be here, and happy to talk about anything and all things real estate syndication, especially in these very interesting times.
Yes, exactly. And we're recording this podcast towards the end of April of 2020, so we're still in the midst of the COVID crisis. So Peter, can you tell our listeners, what you primarily spend your time on, and we can kind of divert the conversation from there?
Yeah, absolutely. So I'm a partner with Sklar Kirsh. I'm one of the sort of unusual hybrids in the corporate and the real estate groups. I've got a background in both, and that means I basically mainly spend my time on the sort of corporate aspects of real estate. So syndications, private placements, joint ventures, do a lot of capital raising. We represent developers, syndicators, also lenders. And then I do, as you mentioned, a lot of general corporate, some M&A, and also the sort of dirt aspects of real estate, acquisitions, divestitures, sales, refinancings, so sort of all of the above. But my main focus is kind of the joint venture, syndication, capital raising world involving real estate.
Awesome. So great, breadth of experience in the industry. So from a legal perspective, when, you're meeting other people specifically within the real estate community that want to go out there and they have a deal and they don't have all the money to do it, usually you form a syndication, which is what, my company does as well. So when you form a syndication, you're pooling financial resources together to buy and attack a larger project. So how does a syndicator go about that? If they wanted to post it online and attract capital there, or talk to friends and family, how does that work? Is there any legal, insight you can provide?
Yeah, sure. This is a very challenging area for a lot of real estate operators because they just think, hey, I'm doing a real estate transaction. What do I mean? I need to worry about these things called securities, and there's all kinds of laws. A lot of people may have heard 506B or C. And in particular, right now, I think the SEC has a focus on, the practice of people using others and sort of unlicensed finders to raise capital. So there's a real focus, especially with the advent of crowdfunding coming in. And you really need to be careful, and you need to work with, advisors, lawyers, CPAs, and everyone who knows the real estate side, but also knows the securities side. We toss around this word securities, but basically if you are taking money from other people and they're going to be passive, they're not going to have control, and they're going to count on you, right? They're going to write you 100,000, whatever check, and say, here, take my money. I don't make any decisions, go make me money. That, in essence, the controlling aspect is a security. So if you're raising money basically from passive investors, you need to worry about securities laws. And that's where, anybody from Apple to any of these other public companies you hear of, they're doing public offerings of securities, and it's very expensive and time consuming. So as a real estate operator, you're not going to want to do that. So the rule is you have to do a public offering unless you have an exemption. And that's where these 506B and 506C terms come in. And the traditional exemption that most real estate operators and frankly private funds relied on was 506B. This was before the Jobs Act, and that basically says, you have your doctor and lawyer friends, or you belong to a country club, and you go and you sort of form relationships. You can't advertise. You couldn't post on LinkedIn. You couldn't go to a real estate conference and start talking in front of a bunch of people you don't know about your deal. And that's sort of the traditional way of doing it. You have what's called a private placement memorandum or some sort of disclosure document. You form an LLC and you have a class of passive investors that you bring in money from, and you have some waterfall of distributions, to them and a preferred return and that kind of structure. Then along came 506C, which is with the Jobs Act a couple of years ago. And if you use 506C instead of 506B as an exemption, then you can advertise and you can post on LinkedIn and Facebook. But the difference is you have to verify that all of your investors are accredited. So in the old way, 506B, which is still used quite a bit, and in fact, probably the majority of what we do, but you could just get an investor to sign a certificate, right? Stating, I certify that I'm accredited. In 506C, if you want to advertise, you can't do that. You need to actually get a third-party verification provider or their lawyer or CPA to sign off, hey, I've looked at their financials, somehow I know that they're accredited. And another word that you hear a lot is accredited, right? And that means you have a certain amount of net worth. You have $1 million of net worth, not including your home. You make $200,000 or $300,000 with a spouse for the last 2 years. There's some level of testing for these various accredited tests. So I know I said a mouthful and I'll stop there, but that's kind of the two regimes mainly used by syndicators.
No, that's perfect. Now, a follow-up question to that conversation would be, how could someone go out and, whether they're new to the business and they don't really know if someone's accredited or not, or they don't necessarily need to target accredited investors. Can you still have non-accredited investors participate in your opportunities? How does that work?
Yeah, so under 506B, you can have up to 35 so-called sophisticated but non-accredited investors. And sophisticated basically means that they don't meet the monetary test, but either themselves or through an advisor, they basically have the experience of investing in deals like these. They can understand them. They can look at an operating agreement or a PPM, and they can understand the waterfall and fees. And so in some way, they're experienced, but they don't meet the monetary tests. Now, the issue is if you include sophisticated, while you can, it's a lot more expensive because there's more disclosure requirements. There can be, audited financial requirements. So it gets expensive and more time consuming. So yes, you can do it. We typically try to advise our clients, if you can use only accredited, even if you're under 506B, it's much better. But yes, you can. They still have to be sophisticated though, and have that sort of experience, or an advisor, somebody who can, advise them on the documentation.
Got it. And I think our listeners would appreciate, let's just say you're trying to get into real estate and you have a deal that you came across and you're trying to figure out how to capitalize it and what the debt and equity is looking like. And you're going to networking events and you're kind of talking to people about what you do. And one of them says, I've always been interested in investing in real estate. I have some money in the stock market. I want to take it out and do that, but I don't want to be active. And it's like a perfect fit. So, but it's just within the one conversation, right? So you still can't say, well, this is what I do. I actually have this deal on the table. You can't do that still. You have to build a relationship first. Now, what qualifies as per the SEC a pre-existing relationship where you could, have that conversation maybe a little bit further down the road, just not on the first, impression. And how does the SEC even regulate that? Because they're not like listening in on your conversations. How does that
Right.
work from
Yeah.
your perspective?
So yeah, to answer the last part of your question first, I mean, they will never know, right? Unless that investor or another investor who happens to be in that deal gets, a return that they're not happy with, something goes wrong, and they, either go to a state regulatory agency or the SEC and, hire a contingency securities lawyer and they start digging into all this stuff. But, what the last position you want to be in is after your deal is done and somebody is unhappy, somebody starts turning over all the stones and finds a way that your exemption that you relied on to do the deal doesn't work. There could be fines, there could be so-called bad boy acts and stop you from raising capital in the future. So, in each particular deal, maybe it's unlikely that the SEC will say, aha, you talked to this person in 6 days and not 7 days about your deal, but you want to be careful and you want to make sure that you're doing all these things correctly in case something happens down the road. So, look, how many days do you have to wait? It's not totally clear what the exact cooling off period is, but what is clear is you can't meet somebody in that same day, present them with your deal. You can talk about what you do, you can talk about your business, the kind of deals you like. And then, like you said, if you meet somebody who seems interested at a conference, you give them your business card and you say, hey, let's, talk about this further. Let's, meet, let's have in this day and age, follow-up Zoom call and you can get to know the business, maybe meet some of my partners. And then after, is it a week? Is it 2 weeks? I think some of the crowdfunding platforms have like a 30-day cooling off period to be sure. So it's not totally clear, but let's say it's, 2 weeks later after you've had a couple of conversations with them, then you say, and here's one of my active deals if you're interested, right? So you've established a relationship where the point is it's not like they've just met you, they're super interested, they're very hot on what you do, and you present them with a deal and they don't have this cooling off time to sort of go back and think about if they really want to invest and there's not that pressure there. Now, it's a little bit fabricated, and hopefully if you're talking to somebody at a real estate conference and they're interested, they're interested because they're interested and you're not pressuring them. But that's the idea, right? You want to have this cooling off period where they can sort of go away and think about it and come back and still tell you, yeah, I really would like to invest with you.
And that's important anyway to have, whether the SEC was involved, or not, because, you want to build trust with people and you want to, for me, it's more of educating, someone first, because I have had people who say, oh, let me know your next deal I'm in, for 50, 100,000, whatever it is. I said, well, hold on a second, slow down, go to my website. I have a lot of, podcasts. I have educational videos. I just want to make sure when you're ready to get there, this is something that you really understand and you're educated and you're going to pull the trigger on eventually. So I think regardless, I think it's a good thing that the SEC, to some extent, I'm not very heavy on regulations in general, but that's actually a good thing that kind of puts operators in line too, that helps build trust with their clients and, with their business. So I agree with that.
And by the way, look, for the sponsors, it's a good idea to get to know your investors or potential investors as well, right? I mean, they may say something in a conversation with you and you're like, well, you had a problem with your last operator, or maybe they say something that lets you know they really don't understand what they're getting into, and you have an obligation to sort of vet the investor just as much as they have an obligation to vet you. And I mean, I agree with you. You know, a lot of times there's overregulation, right? But the securities laws in the U.S. have worked pretty well, right, since the late 20s and early 30s when they were created. And yes, some people, in this day and age are saying, well, the accredited, levels should be relaxed, and I think the SEC is looking at them. But as far as the rest of the world goes, the U.S. has been a very stable place to invest since these securities regimes in the late 20s and 30s were put into place. So they've worked pretty well.
No, it makes a lot of sense, and provides, it really provides, normal individual and even accredited individual on, a lower basis to access to these types of opportunities, because this didn't used to exist. Even 5-7 years ago, they didn't used to really exist. So it's a very, very new space and very interesting. Can you talk to our listeners about, okay, so you have, you had a deal, you have, investor capital kind of in mind or lined up. What are the sort of documents you need to make sure that you're in compliance with, Reg D and the SEC laws if you decided to go that 506B route with your friends and family?
Yeah, so 506B or 506C, the documents are very similar, minus sort of the investor verification part. But typically you would have either an operating agreement or a partnership agreement, depending on if you're creating an LLC, and I think that's the usual vehicle. A lot of times syndicators will also pick a limited partnership. But some sort of, SPE entity, and you have an operating document for that entity where your syndicated investors are going to come into. And then you'd have a manager entity, most likely also an LLC. And then you would have a subscription agreement, which is the document where your investors basically sign and say, I'm investing $100,000. I've read all the other documents. I certify that I'm accredited. The company makes certain representations. And then the last piece is the private placement or other disclosure document where you basically explain the deal, explain all the risks to your investors, and disclose anything that's material. Now, a lot of times people will ask us, well, do I need a PPM? When is it required? And the answer is, if you have all accredited investors, you are not legally obligated to have a PPM. The rule is you're obligated to disclose to those accredited investors anything and everything that would be material to their decision to invest. Now, if you have non-accredited investors, again, the disclosure requirements are much broader, and you definitely do need a PPM. But even in the world where you're only having accredited investors, we usually say to our clients, look, we recommend you have a PPM, but it's a function of who your investors are, how well you know them, how many there are, how much you're raising. So it's a business decision. If you're, raising $100,000 from 3 of your friends, technically that's a securities offering, but you probably don't need, nor would they be expecting, a PPM. If you're raising $2 million, but it's still from, 3 of your friends plus 2 people that they brought to you, maybe you don't need a full PPM. Maybe you have a subscription agreement with an exhibit with risk factors in it, right? But if you're raising $5 million or even $2 million, and you're going out and you're on a crowdfunding site, or you're somehow bringing in investors that you don't know, and there's going to be 30 of them, then even though you're not required to have a PPM, we always would recommend that you do, because you think about it like a big insurance policy, right? If something goes wrong, you want that big disclosure document where your investors can't say, hey, you never told me this, new construction was being built on a former gas station site. And you can say, well, yeah, it's on page 63. It's a big risk in the PPM. The other factor is optically what your investors and what the market is anticipating. So if you're on, CrowdStreet or any of these crowdfunding sites, they're going to expect to see a package including a PPM and a subscription agreement. And so you have to take that into account as well. But it really just depends, which is something I know people hate to hear from their lawyer. But usually if you're doing a real broad syndication with people that you don't know, we still always recommend that you have a PPM or some disclosure documentation.
Got it. That's great. And another question I would have is there are a lot of, operators out there, like you said, they want to do things the right way from the start, and they want to have the PPM, just like you said, it's more of an insurance policy. But then a lot of them kind of pause because they look at the cost of the PPM. Can you kind of describe the cost, almost
Yeah.
like a benefit analysis to having a PPM when you only have, like you said, 5 parties on whether, like you said, it's a $2 million raise or $5 million raise? Is it still worth it at that point? Because it could be in the tens of thousands of dollars of PPM in my experience.
Yeah.
What's your
Yeah. No,
opinion?
look, a full PPM package with, operating agreements, subscription agreements, it's probably in the $20,000-$25,000 range at our firm. I know some firms are cheaper, some firms are more. But again, you would probably rather spend $25,000 than hundreds of thousands of dollars on the back end when somebody is coming after you. And typically, like, we work with clients on a multi-deal basis, so their first deal will be probably more expensive, and then we'll have like a form PPM, and they use it more regularly, and it's less costly as we've developed it for the first deal or two. But you're right. I mean, look, if you have 3, 4, 5 investors and you're raising $250,000, you may not want to spend 10% of that raise on a PPM, and you may not need to. You can do a PPM light, which is, as I said, like the subscription agreement with the risks built in as an exhibit. And then you're spending more like 10,000 or 7,500. But again, I always think it's better. I mean, I may be a little biased, but you spend a little more in fees to get your documents, done professionally and correctly at the outset. I also think that gives you an advantage with vis-a-vis other operators when you're going out to investors, because it looks just optically better and they know you've had somebody professional prepare it. But you certainly have to balance the cost of the amount of your raise, who your investors are, with the cost of the legal. Like, I would never say you always need a PPM, even if you have 3 of your friends and you're raising $200,000. No, but you want to be protected as well on the other side.
No, makes a lot of sense, and that's why Peter's a good attorney. So
we like to consider the business aspects as right.
Right.
You never want to be one of those lawyers that just says do these documents and doesn't take the business realities of the deal into consideration.
Definitely. So kind of, winding this podcast down, usually at the end of each episode, I ask just 3, questions, fire round questions.
Sure.
First one being, do you have a favorite, real estate book or business book?
I have many. I'm one of those people, like so many out there, who read Rich Dad, Poor Dad, quite some time ago, and it really changed my focus. Whether, a lot of people have their thoughts about Grant Cardone, but his book 10X is really powerful. I have a couple books that are written by clients of mine. Hunter Thompson wrote a book about syndication, and I can certainly provide people a link there. There's another guy, a syndicator, Reed Goosens, who's Australian, who wrote a book all about investing in real estate in the US, which is great for foreigners, but also really has a plethora of information for folks that are just trying to start out in the syndication business. And then we can talk about books like, anything by Ayn Rand and all kinds of things that are not specifically real estate related all day. So I'm happy to provide anybody who's interested a list of things that I like to read and, when I'm not reading legal documents.
Awesome. No, that's a good list. I've read quite a few of those. And I guess secondly would be, what are your hobbies outside of real estate and you know, your professional life?
Well, right now in the middle of this pandemic, I am perfecting my cocktails and my meat smoking. We've done whole chickens and ribs and brisket, but look, regularly I'm pretty busy with work. I have a 7-year-old son, so between him and my wife and doing family things, that keeps me busy. But we love to travel. Occasionally, I've been known to go surfing and sailing out here in California. Normally, we could do that year round. Love listening to music, working out when I have time. Those are the typical things. And right now, just trying to stay sane mainly.
Yeah, aren't we all? And lastly, who would be one of your top role models that kind of formed you to where you are today?
Yeah, I have a lot of attorneys, sort of mentors. There was a guy named Sal Lavinia at my last firm that I did a lot of work with. Back in New York, Dimitri Mastropola, who's actually now he works for Major Hagan and does placement of attorneys. People that have sort of guided me along the way. One of my first clients, actually, who's out here in California, is Leslie Smith. I kind of interned with her. I was a lawyer at the time, but I was doing sort of more corporate finance and hadn't really gotten into real estate. So I interned with her, and she had about 12 properties out here in Long Beach, and I really looked at the various properties. Did some underwriting, sort of just did an internship and mentorship with her. So that was really eye-opening. Kind of got me into real estate investing myself. As did Jeremy Roll. I don't know if you know who that is. He's a guy out here on the West Coast who runs a meetup group and started Phoebe, which is for investors, by investors. Kind of a real estate networking, no sales pitch group. That's really blossomed. I started with them, I think, at the first chapter. There's something like 18 or 19 chapters, and I've gotten countless clients from and in that group. Man, there's been so many. I think real estate and business really is a team sport. That's why I'm happy to be on shows like yours and just give your listeners and anybody who's interested any of the knowledge that I have, because so many people have sort of helped me along the way too.
Really excellent. Awesome, Peter. Well, how can people find you if they want to reach out to you?
Yeah, the easiest way is to email me. It's pfischer, Fischer, at Sklar Kirsh, which hopefully you guys can see, the SKLARKIRSH.com up there on my lovely Zoom virtual background. Look, I'm happy to talk to any of your listeners, have an initial conversation or just bounce ideas off each other and, just be a resource.
Awesome. Well, Peter, we really appreciate you coming on. And, what I'll end up doing is posting a link to your LinkedIn and, your emails in the comments section of this episode so people can reach out directly, or you can reach out to me and I'll put you in touch with Peter. And thanks again for coming on. This is Discovering Multifamily. I'm your host, Anthony Scandariato, again. And until next time. And thanks again, Peter. We really appreciate your time.
Thank you. Enjoyed it.
Great. Thanks.